Thanks, everyone, and welcome back. That was Brian Coffey giving us his views and observations of what he's seeing globally in emerging markets. Next up, I'm very excited to welcome Robert Promisel. He's a senior member of the investment team at Resolution Capital and a portfolio manager on the Nedgroup Investments Global Property Fund. Rob, welcome. How are you?
Good afternoon. I'm great. Thanks for having me.
Brilliant. So, Rob, I mean, there's obviously been so much market volatility around, but let's just kick off the presentation with a bit of a focus on Q1 of 2025. And it's just interesting that the global property index did better than the MSCI World over the quarter. Can you please talk us through the fund's performance?
Sure. So the portfolio had positive performance in the first quarter. It slightly trailed the benchmark, though. Contributors to positive performance included an overweight position in healthcare, really driven by seniors housing, including our largest position in the portfolio, Welltower, and the largest relative overweight position in the portfolio, Ventas. We're underweight industrial, and we're overweight self-storage. Some of the detractors to performance included the exposure to some of the retail positions in the U.S., particularly Federal Realty and Kimco, as well as the overweight position to data centers, which retrenched during the quarter, and then some of the office exposures declined. So that's really what drove most of the relative performance. The U.S. was the largest regional exposure, and that was a modest detractor given some of the position I just mentioned. And then the exposure to Australia and New Zealand was a positive contributor, in particular, bullet dodged by not having any exposure to Goodman, which fell nearly 20% during the quarter.
Thanks, Rob. And what about the fund's sector positioning, please? I mean, I know you definitely have some interesting and unique investment opportunities like data centers, as you alluded to, but there's many interesting sectors in the portfolio that you can invest in.
So what's great about investing globally in real estate is that there is such a broad menu of investment opportunities diversified by sector. So the portfolio's largest sector exposure is to retail, which very much is a necessity-oriented retail shop, typically grocery-anchored shopping centers and regional malls. One of the larger sector exposures is also healthcare, which is really driven by seniors housing. As we'll discuss a little bit later in the talk, seniors housing is undergoing tremendous growth cycle right now. Residential is also a meaningful position in the portfolio, really driven by exposure in the U.S., where there is just an undersupply of housing. There's a bit of obsolescence, and there just isn't enough new housing that's being constructed. And so the portfolio has a significant exposure to a whole range of rental housing in the U.S., from multifamily apartments to single-family rentals to manufactured mobile home communities. The diversified sector has become much larger in the portfolio as we've increased the position in Japan to large diversified companies like Mitsui Fudosan, which owns office in central Tokyo, retail across Japan, as well as logistics. And then also in the UK to some of the large diversified property companies like British Land, which owns clustered offices in central London and regional parks around the UK, and Land Securities, which also has central London offices, as well as a regional mall portfolio and residential development in the UK. You mentioned data centers. It's long been a position in the portfolio. We actually pared it back a little bit during the quarter. There was some news that hurt the stocks a bit. Really, when we heard that Microsoft was pulling back slightly on some of its data center expansion plans. We don't think that this is a permanent feature. We remain committed to, we believe that data centers are going to continue to have very strong growth going forward. in part because supply remains limited due to constraints on development, primarily the provisioning of energy. So those are the major sectors. And then I just point out industrial at about 5% position is a significant underweight in the portfolio as we see the fundamentals in that sector roll over and turn.
Thanks, Rob. And just, I guess, taking a forward-looking view, what are you seeing with respect to the valuation of the various REIT sectors and subsectors, please?
Look, we actually see that there's pretty attractive values for the stocks. The REITs in general are trading at significant discounts to their net asset values. They're trading at attractive implied values per square foot or per unit, and the implied cap rates are higher than they've been in quite some time. I just point out on slide 5, healthcare at 4.8% looks low, but when you match that with a growth profile, actually we think that it's value for money, that you're paying a low implied cap rate, but you're getting well above average growth. In comparison, in office, you're getting a higher implied cap rate, but the ability to access cash flow growth is going to be a little bit challenged given the capex needs and the leasing challenges facing some of the office companies.
Thanks, Rob. And perhaps if you can please give us some more context in terms of the returns for the real estate sector versus the other categories, please.
So I think it's really interesting to look at global equity performance for real estate compared to other sectors. And you'll see on this slide that it says calendar year to date. Actually, it's April month to date. And the point here is to show the real estate was down since April 2nd through April 9th. But in fact, it actually fared much better than many other sectors in the equities market. And that's because we think that real estate continues to have visible and predictable cash flow and earnings.
Thanks, Rob. And then perhaps if you can just please give us a more detailed update of what's happening in the logistics space as well, please.
This portfolio has been underweight logistics for over a year. We've been concerned about moderation in the earnings profile for the sector as the extremely strong, almost frenetic leasing environment during the pandemic cooled. And so we're seeing market rent growth, not just slow, but in many of the major markets decline. They're declining from higher points, but we think that going forward, it's going to be challenging for some of these industrial warehouse owning companies to grow earnings, particularly should we face a higher interest rate environment and some of the financings that they have mature need to be rolled over. So we've been concerned about the growth profile, the prospective growth profile for industrial REITs for the better part of a year. Now that the world economy seems to be slowing, there's even more concern about the future pace of demand for industrial, hence our underweight.
That sounds very interesting. Thanks, Rob. And just, I guess, healthcare, as you alluded to earlier, is a pretty important component of the portfolio. Can we please discuss this in a bit more detail?
Look, we think that healthcare is in the midst of a cyclical and structural growth story right now. We're seeing occupancy continue to be repaired following a sharp fall off during the pandemic. And we still have another probably 2 to 3 years of increased occupancy levels going from currently 87% into the low 90s. In addition, senior housing operators have pricing power and they're able to drive rents above the rate of inflation. Now, why is this? And that's because demand is really driven by demographics, much more so than by economic cycles. So we actually think that in and of itself, in a period of potential economic uncertainty, is also a bit of a safe harbor. But the reason why demographics are so compelling for seniors housing in the US and Canada and in the UK is because the typical entry age for a resident of senior housing is 80 years old. And we are now just on the cusp where the baby boomers are turning becoming 80 years old and turning into their 80s. We think that the baby boomer age cohort is going to grow roughly 300 to 400 basis points more per year than what we've seen in senior housing over the past 10 to 15 years. At the same time, because it's not just all about demand, but we're not seeing really any new supply being created. It sounds a little counterintuitive given how strong the demand is, but frankly, there isn't a lot of construction lending for seniors housing right now, given the regional banking crisis that happened nearly 2 years ago that really cooled down construction lending. So we're in this really I almost wanted to say use the phrase sweet spot for seniors housing, where you're going to have supernormal demand for the next 10 years. And for the next 4 to 5 years, you're not going to see an adequate supply response. As a result, senior housing NOI is going to grow. Net operating income we expect for Welltower, the largest position in the portfolio, it should grow in the mid-teens per year over the next 3 to 4 years, leading to nearly over 10% or double-digit earnings growth.
Wow, that's quite an interesting dynamic. I guess the other interesting one in the portfolio is that you moved to an overweight in retail within the fund. Can you please give us an example of one of the companies that you like, please?
So Shaftesbury Capital has been a long-standing holding in the portfolio for many years. It's a roughly 4.5 billion sterling mixed-use portfolio, really skewed towards retail in central London. They own Covent Garden, which I'm sure many of the listeners would have heard of if not visited, Carnaby Street, which is just off of Oxford Street, as well as Gerrard Street, which is one of the main retail streets in Chinatown. We think that they're extremely well placed in central London for not just international visitors, but also locals. For many, many years, Covent Garden was sort of shunned by many of the locals, but it's gone through a regeneration, a renaissance, particularly in the hands of Shaftesbury Capital, that's really improved the offer. And so we're seeing increased numbers come to Covent Garden. We think that Shaftesbury Capital, particularly since it's just sort of re-geared its capital structure by selling 25% stake in Covent Garden to Norges at book value, which has allowed the company to reduce its leverage into the low teens and positioned it for growth going forward. We think that Shaftesbury Capital is well placed for visible earnings growth going forward.
Thanks, Rob. Very interesting. And I guess finally, before I let you go, I just wanted to tap your brain in terms of the outlook for listed property markets, please. I mean, what are your observations and thoughts on that?
Look, we think that real estate continues to have a similar outlook as to what it's had previously, which is one driven by visible cash flow growth. The platforms in which we invest are typically among the best in the markets they operate. They have tremendous operational scale. They have better operating margins as a result of many of their competitors. And because they're public and many have investment grade ratings, they have multiple avenues to capital, both in the equity markets as well as in the debt markets. It's why it's so striking, so surprising to us to see that they're trading at such significant discounts to net asset value currently. These are companies that are going to have visible, stable earnings growth, visible, stable dividend growth as a result, and a very sensible capital structure for many of the markets. So we think that REIT should continue to provide stable investment returns going forward.
Brilliant, Rob. Thanks very much. Always lovely hearing from you, and we really appreciate that you took the time to join us.
Thank you very much. Have a great day.